The IRA tax break can put $6,000 into your retirement account while lowering your taxable income by $6,000. Anyone, I repeat, anyone can take advantage of the IRA tax break, regardless of if you're self-employed or employed at another company. Still, many people are not taking advantage of this very simple tax break. And some of the people who are being surprised by a huge mistake that they are making that is ultimately preventing them from taking this deduction altogether. So stay tuned to find out how all of this works, how to avoid the mistake many people are making, and ultimately knock off $6,000 from your taxable income. What's up, everybody? My name is Sherman, a CPA here at Life Accounting, where we help you save on taxes while boosting your profits. In some of my past videos, I've covered things like the SEP IRA and the solo 401k to help self-employed individuals deduct up to $58,000 from their tax bill. And if you haven't seen those videos, I strongly recommend you to check them out. Those plans, while beneficial, had some rules and regulations attached to them that may not apply to everyone. That's why today's episode is all about the traditional IRA tax break, which anyone watching this video can take advantage of. So if you're new to our channel, be sure to like and subscribe so you don't miss out on more ways to save on taxes. With that said, let's go ahead and discuss the IRA tax break. Let's run through the basics and then we can get to the fun stuff. All right, so what is an IRA? An IRA is an individual retirement account that allows individuals to save for retirement on a tax-deferred basis or a tax-free basis. Now, there are two basic types of IRA accounts, a traditional IRA and a Roth IRA. Now, a traditional IRA is where the contributions you make to your IRA are tax-deferred. So basically, you are not paying any taxes on the contributions you make until you withdraw them from your retirement account. For example, if you make $50,000 per year and contribute $5,000 of your income to your IRA, then hypothetically, you would only pay taxes on $45,000 in income. You would not pay any taxes on the $5,000 you contributed until you withdraw it, which is typically after you are 60 years old to avoid paying early withdrawal penalties. The Roth IRA, on the other hand, is taxed differently than a traditional IRA. With a Roth IRA, you make contributions with money you've already paid taxes on. So let's say you made $50,000 and after tax, your net income for that year is $40,000. Then you put $5,000 into your Roth IRA. Well, that $5,000 would not lower your tax bill when you file your taxes because you've already paid taxes on it. However, on the flip side, you will not pay taxes on this amount when you withdraw it at a later date. Now, while the Roth IRA has some other pros, we are going to focus on the traditional IRA and how you can take advantage of the associated tax break successfully. So here's how the traditional IRA tax break works. According to the IRS, the maximum contribution you can make to an IRA account is $6,000 per year or $7,000 if you're over the age of 50 at the time of this video. If this is contributed to a traditional IRA, this means that you would typically deduct this amount from your taxable income when you file your tax return. So basically, if you contribute $1,000, you will be able to deduct $1,000 from your taxable income. Or if you contribute $5,000, you would deduct $5,000 from your taxable income. You are essentially funding your retirement and reaping tax savings at the same exact time. But there is a big mistake that trips up many people when they're trying to claim this deduction. Now, this mistake can be summarized by not understanding the IRA deduction limits. A lot of people do not know this, but your deduction can be limited if you meet certain criteria. The first criteria is if you are covered by a retirement plan at work. The IRS specifically says that your deduction may be limited if you are covered by a retirement plan at work and your income exceeds certain levels. We'll discuss those income levels in a second, but basically, if you or your spouse is employed by a company that offers a retirement plan, your deduction may be limited. If you or your spouse's employer contributes to a profit-sharing 401k, stock bonuses, or any IRA-based plan, then you are considered covered. This means that your deduction may be limited if your income surpasses a certain amount. So let's go ahead and take a look at those income limits. Here are the 2021 income limits. As you can see, your deduction is phased out once you start earning over a certain amount of money. Now remember, these phase outs only apply if you or your spouse is covered by a retirement plan at work. So let's say you're single and your employer contributes to your 401k plan. If your income is less than $66,000 per year, then you can enjoy the tax benefits of both your 401k and your traditional IRA plan. But if your income exceeds $66,000 and is less than $76,000, then you will only receive a partial deduction for your IRA contribution. And if you make more than $76,000 as a single taxpayer, then you will receive no tax deduction at all. The same applies for married taxpayers. If you are married filing jointly and your joint income exceeds $198,000 and is less than $208,000, you can only take a partial deduction of your contribution to your IRA. And if your joint income is above $208,000, then you can forget it. You won't be able to take any deduction for contributing to your IRA account. And if you are not able to get your tax deduction for your contribution to your IRA account, then you're basically locking up your money without any tax benefit. Sure, your money will grow and you will not be taxed on the earnings you accumulate in your account, but missing the deductions for your contributions is a huge blow. So let's get this right. Again, if you or your spouse is not covered by a retirement plan, then there is no income limit associated with your IRA. You can take the full deduction. But if you are covered by a retirement plan at work, then you need to closely look at the income limits by the IRS. I would hate for you to think that you're getting a tax deduction and you put all your hard-earned money into an account that has limited tax saving potential. And the last thing I'd suggest here is to make sure you understand the deadline to make contributions to your IRA account. Typically, you need to have made your contributions to your IRA account before the tax deadline for the year you are filing your taxes for. Now, this is actually kind of cool because it allows you to make contributions into your IRA after the close of the tax year. For example, assuming the tax deadline to file your 2021 tax return is April 15th of 2022, then you could go the entire year of 2021 without making any contributions and still take advantage of this deduction so long as you contribute by April 15th of 2022. So there you have it, folks. You can pay less in taxes by contributing to your retirement through a traditional IRA. Just make sure you understand your coverage through other employers you might work for, even if you are the employer. If you enjoyed this video, please let me know by clicking the like button below. And be sure to subscribe so you don't miss another episode that might help you save $1 or $2 on your taxes. I'll see you in the next episode.